What's up, everyone? It's Cowdy with MoneyVest. So in this video, we are going to be talking about the GDP numbers that came out. I'm going to break down the economic numbers and, of course, go over the jobless claims and also talk a little bit about the PCCE. That's the put call ratio for equities, which is given to us by CBOE. And very, very important metric, which basically identifies when there are oversized positions when it comes to puts versus calls. In other words, there's more put options open versus calls. Now, that may be used as a hedging indicator. Basically, Wall Street and institutional investors and hedge funds are looking to hedge their positions, right? That's why they're buying a lot of put options, and they're kind of overpowering the calls right now at the moment. And that usually creates a contrarian indicator, in my opinion. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. We'd love to have you on board as a MoneyVest member. You do get a 16% annual discount before the end of this year. And of course, you can access all the members-only private videos. A lot of educational content is going to be included in our Patreon, and access to our intrinsic value spreadsheets, and not to mention our individual stock reports. There's going to be a lot of research and analysis and educational material included, and early access to our MoneyVest Pro platform that's going to be launched in 2024. So link's going to be down below. You can also go to moneyvest.com and access everything over there as well. So this right here is going to be the personal income and outlays. Now, this comes out tomorrow, right? Tomorrow at around 8:30 a.m. Eastern. It's going to come out. Very, very important numbers, because PCE is basically the Fed's preferred measure of inflation, right? So they're not focused on CPI or PPI. They're focusing on PCE, right? So month over month expectations of 0.3%, and year over year we're expecting 3.4, which is going to be a slight decline from 3.5. And core PCE, more specifically, is what the Federal Reserve is tracking, which is excluding for food and energy. 3.9% prior number, 3.7% is going to be that consensus, which again is going to be 20 basis points lower than where we were in the previous month. Now, going over to jobless claims, 210,000. Still very, very subdued. I mean, this number has not even breached over 250,000 in the last, I think, 6 months. If you take a look at 6 to 12 months rolling average, we're still at around 200,000. And the moment it gets up to over 300 and 400,000 is really when things start to become a little bit more interesting. You can see the 4-week moving average over here. So last 1 month moving average is at 207,000. I think it's the same for the last 3 months and 6 month moving average as well, where the number is pretty much at around 210, 215,000. So that's where we are with jobless claims. And look, this is as great of a catalyst this is for the economy. And this, to top it all off, you're seeing the US GDP grew at 4.9% annual pace in the third quarter. That's better than expected. And that is excellent. Like, this is fantastic growth for the US economy. So if you take a look, the GDP measure of all goods and services produced in the US rose at 4.9% annualized pace in July through September. And that's up from 2.1% in the second quarter, and economists were expecting 4.7% acceleration. So this is just a fantastic increase. I mean, given the size and scale of the US economy, a 5% increase is fantastic, right? There's no two ways about it. Now, one of the things I do want to point out is that even though this is fantastic news for the economy in terms of, low levels of jobless claims, high, significant growth in US GDP, of course, we'll learn more about the PCE numbers coming out tomorrow. The only problem is that if this number was coming out right on the back of a PCE and core PCE sitting at under 2%, right now we're expected to be at 3.4, 3.7%, I would have been all but like, that's fantastic, right? That's incredible. I mean, this is literally just a soft landing scenario playing out, because you've got stronger economy, you've got low levels of unemployment, and you've got low levels of inflation. And that's exactly what the Federal Reserve wants. Let's start cutting rates, and that's going to be bullish for the overall market. The only problem with that is that we're not there yet, right? Inflation is still elevated. We are still very much in the 3.4, 3.7% range, which again is almost twice as much the Fed's target. Not to mention the jobless claims and economic growth coming in super strong. And what does that do? That paves the way for the Fed to keep hiking, right? In our previous videos, we've talked about how the Federal Reserve is pretty much punishing the economy for being too strong. They are very vocal, and they are very clear in their ideas that, look, the economy needs to slow down. Unemployment needs to go up. There needs to be some weakening in the labor market in order for inflation to come down. They're very, very clear about this message. And, for that reason, I think it's possible the market may see that as somewhat of a negative, although pre-market, technically speaking, we are starting to move back higher a little bit. Volatility did open up to as much as almost 22, and then still up 4%, so almost at 21, so starting to pull right back down. And we do have pre-market, so if you come over to QQQs, pre-market, we are down about 53 basis points. We were much lower, right? We were significantly lower than where we are at the moment. So if you come over to the 5-minute chart, you'll notice that we are getting bought up. Right now, we opened, I think, down over 90 basis points, and this right here is the potential move of 64 basis points at the moment. There's a very, very important level of support that the NASDAQ needs to hold today. The bulls need to hold, and that's the 200 simple moving average, right? So if I bring out the moving averages here, you'll notice that the 200 SMA, that's the blue line you see on the chart, sits at 12,750. I did a video on this earlier today, and that's the level the bulls absolutely need to hold at all costs. If you do see a breakdown below this, well, then unfortunately that would be a big breakdown for the NASDAQ, and it's possible that we do accelerate on this downtrend even further. Now, the real more important piece of the equation is going to be this PCCE, that's the put call ratio, and it just jumped over 78% from yesterday's close at 1.33, right? That simply means that there's 33% more puts out there than there are calls, and this can be a little bit of a contrarian indicator. Even though hedge funds institutions like to hedge their positions with buying puts and selling calls, it's possible that they're doing that, right? They're speculating that, okay, there may be more downside, so we want to have that extra protection with buying puts. This doesn't mean that it's time to go bearish. In fact, quite the contrary, right? The moment it jumps to over 1 is usually the best time to be looking at buying stocks, because every time it does get up to over 1. At one point we were at over 3. This was back in January of 23, and since then we know what happened to the market. It's just been on a consistent rally upwards, and there's been a couple more times. You can see March it got up to 1.47, and historically it's been a little bit more lower. It's been under 1, but this right here is March of 2020 when again we were at 2.85. So what I'd really like to focus on, in terms of levels for this is closer to 1.9 and closer to 2 levels. And we're going to include this in our back testing as well to better understand, okay, every time, the put call ratio jumps to a certain level at 1.5, 1.75, maybe 2, what is the probable outcome in the next few weeks to a few months for the markets, and how does that play into our analysis with respect to volatility, and not to mention the percentage of stocks that are trading above or below certain moving averages, right? So if you take a look at where we are with the S&P 500 stocks trading above or below their 50-day, 100-day, 200-day simple moving averages, we are still low, but not low enough, right? We want to get this number down in the mid-teens, sort of like even lower in the mid-single digits would be ideal for us to start looking at dollar cost averaging and be a little bit more aggressive. But right now we are just consolidating sideways at the moment, and of course the overall market is making lower highs and lower lows with a lot of big tech just dropping like flies. I mean, if you come over to Apple here, down 0.5% again after being down over 1.3% yesterday. Amazon's reporting later today, down another 1% pre-market. Not to mention Meta, definitely selling off, down over 4%, so giving up back on all the gains from yesterday and selling off even further. And of course, we have Google also selling off, down over 2% right now, and Microsoft giving back on some of the gains from yesterday, down about 27-30 basis points. And AMD definitely broke down quite aggressively, down another 1%, now trading at just over 95. And Nvidia, not to mention, also down about 1.5%, trading down in the low 400s. So as always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. And don't forget, till the end of this month, you do get access to all the discounts and all the annual discounts and the benefits and the members-only private videos. Again, these are all educational videos that you can access and learn more about fundamental analysis, technical analysis, and the intrinsic value spreadsheets, and the trading view charts and the stock reports are also going to be available, as well as the early access to our Members Pro platform. So as always, happy investing, and I'll see you all in the next video.